Ladies and gentlemen, good day and welcome to the Nuvoco Vistas Corporation Limited Q3 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Mr. Vishnu Sharma, Head of Investor Relations from Nuvoco. Thank you, and over to you.
Thank you, SSC. Good evening, everyone, and warm welcome to Nuvoco's Q3 FY26 earnings call. The results along with the earnings presentation has been uploaded to the stock exchange website yesterday, and I hope you had a chance to review the key numbers. Let me first share the key highlights for Q3 FY26, after which we will open the floor for questions. The quarter began on a challenging note, but as we progressed, we started to see encouraging signs of recovery in overall demand. This improvement was particularly visible in the later part of the quarter as the impact of earlier macro headwinds began to subside. Encouragingly, capital expenditure by both central and state governments seems to have gained momentum, supporting infra activity and cement demand. With this gradual pickup, the broader demand environment appears to be strengthening, setting a constructive tone for the quarters ahead. That said, a significant portion of the planned spending is yet to be executed. Around 45% of central capex and nearly about 61% of state capex remains pending as of November 2025. The healthy pipeline of pending projects gives us comfort that this traction could continue in the coming months. Additionally, as an above normal monsoon, a softer interest rate environment and growing consumer confidence, particularly in rural areas, further reinforce our outlook for sustained demand growth going forward. Now turning to our performance for the quarter, we delivered robust results despite the early challenges from macro headwinds as mentioned earlier. Volumes grew 7% year-on-year to 5 million tons, the highest Q3 volumes ever recorded in our company's history. December was particularly strong, with volume growth of 20%, demonstrating our strong execution capabilities and the resilience of underlying demand. EBITDA for the quarter rose approximately 50% year-over-year to 386 crores, even as price moderated more than the benefit passed through, following the revised GST rate coupled with macro headwinds. Our emphasis remains squarely on premiumization, cost efficiency, which significantly lowers the impact of the price moderation. We are pleased to report that the premium products sustained their share of trade volumes at a historic high of 41%, marking the consecutive quarter at this elevated level. We have consistently expanded our premium base over time. For the 9 months of FY26, premiumization stood at 43%, reflecting a steady uplift of nearly 300 basis points over the FY25 baseline of 40%. This establishes new, stronger base for us going forward and will continue to support our performance. On the cost front, we continue to efficiently manage our operational costs as we achieved the lowest blended cost in the last 17 quarters at 1.41 per Mcal, despite the recent uptick in petcoke prices. Raw material cost per ton, distribution cost per ton also declined quarter-on-quarter, supported by operational efficiency gains. Coming to cement prices, given the improvement in demand conditions and positive outlook, the company undertook a price increase in January, which is expected to further improve our performance going forward. Let me now turn to the balance sheet. During the quarter, we raised 600 crores through CCD issuances, which were utilized to replace an equivalent amount of short-term bridge financing, thereby reducing overall debt levels. We expect to complete an additional 600 crores CCD issuances in the near term to substitute the remaining 600 crores of short-term bridge financing. Our continued focus on a disciplined approach to debt management reflects prudent capital allocation and will support the company's growth agenda going forward. Let me briefly touch upon the Vadraj cement plant. The refurbishment and project execution remains on schedule, with operationalization of clinker unit and grinding unit planned in phases from Q3 FY27 to Q1 FY28. To give you a quick update on our project execution, We have made steady progress at both Kutch and Surat. At this site, key equipment is undergoing extensive overhauls. The engineering, tendering and ordering of all goods and service packages at Surat are now complete, while activities at Kutch are progressing as per schedule. Deliveries on the electrical and instrumentation front remain on track for both locations, and mechanical supplies have already started arriving at site. We've also applied for all the required permits to operationalize these plans in line with our planned timelines. On the logistic front, the engineering scale plan and detailed project report for the Kutch railway line have been submitted to Indian Railways, and the execution order is now at an advanced stage of processing. By the first half of FY27, we expect to complete the overhauling work and equipment installation, followed by trial runs in accordance with OEM protocols. We will subsequently establish operations from the control room. Accordingly, during FY27, Surat grinding unit and Kutch clinker unit will become operational, while in H1 FY28, Kutch grinding unit will get commissioned. The East expansion projects of adding 4 million tons per annum in phases also remains on target. With the East expansion and commissioning of Vadras plant, the company's total cement capacity will scale up to 35 million tons per annum. Post the ongoing expansion at Vadras and the East expansion, the company's growth agenda will continue with a firm focus on balance sheet discipline. We have several strategic options ahead, including expanding our presence in the north through a brownfield project or pursuing a greenfield development in the Gulbarga region, aimed at strengthening our position in the western and central markets. Furthermore, our recent preferred bid status for the GMK R2 limestone block in Jodhpur and Pali enhances our mining reserve base, providing a strong platform for future expansion. Lastly, to briefly highlight our ongoing digitization efforts, we have further strengthened efficiency and transparency throughout the operation. Our customer portal now handles approximately 99% of the total orders, offering real-time control and precision in order management. Following its success in cement, we launched customer portals for our MBM business too. During the quarter, we introduced Nuvoco 0M Unnati app under MBM to digitize influencer loyalty, driving higher engagement, greater transparency, efficiency, and data-powered channel growth. On logistics, the transporter portal now covers inbound and outbound logistics across all plants, delivering end-to-end visibility while minimizing manual interventions. That concludes my opening remarks. I'm here with Mr. Jayakumar Krishnaswamy, Managing Director of Nuvoco Vistas, Mr. Manish Agrawal, Chief Financial Officer. We're happy to answer any questions. Over to you, SC.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Jashandeep Singh Chadha from Nomura. Please go ahead.
Hello.
Can you use your handset mode, please? Your line is not very clear.
Yeah, is it better now?
Yes, please go ahead.
Yes. Yeah, hi. Thank you for the opportunity and congratulations on a good set of numbers despite, weaker pricing. Just wanted to understand a couple of things. Firstly, you mentioned that Nuvoco took a price hike in this month. So wanted to understand when did you take that price hike and how much was the price hike? And is the price hike sustained in the market? First question was that. If you can, clarify that, then I'll proceed with my next question.
Yeah, I guess after a tepid Q3 in terms of pricing, January, December onward demand improved, and then the sustained demand continues in January as well. So around 10th to 12th, around that time, we have taken a price rise in non-trade across the geographies in the where we operate, and also in trade channel, we have attempted a price increase in East as well as North. So we'll have to wait for a week or so to see whether the price rise which we have taken sustains. But as of now, things look positive.
Okay, good to know, sir. And has the demand, tapered off after the price hike, or the momentum continues, which you saw in the first 10 days?
Other than the 14, 15, these are all festive times, so I guess I'll have to discount it's 2 days before and today. I guess demand is good in the first 10, 12 days of the month. So give or take, I think typically after Sankranti, demand improves in all the regions. So that's been the past trend. So it should continue to improve going forward as well.
Okay, good to know that, sir. My second question is on cost. Nuvoco has been giving impressive cost numbers. Now, recently we have seen petcoke prices going up, so I wanted to understand in the fourth quarter what will be the impact of that and going forward as well. And also, if you can shed some light on your capex plan, the amount for next year, FY27 and 28, and how should we look at this?
Yeah. As Vishnu mentioned in his initial comment, our fuel cost rupees per million cal trended at 1.41 in Q3, which if you could have seen in the last many quarters, we have come to around thereabout kind of a number for many few quarters now. We will continue this trend. Already petcoke prices have gone up in the month of December, and including, I'm talking about the current trend of pricing. I guess in Q4, I'm still looking at a similar kind of number, give or take a little bit of 0.01 or something like that. But that's all insignificant changes that may happen. These are basically backed up by 2-3 aspects of the company. One is to work on our AFR agenda in North, the 2 plants as well as in Rizla. The second one is using domestic open market coal. For the first time in the last many years, in the preceding quarter, we have started using good amount of domestic open market coal in our North plants. And that's kind of helped us sober the cost lines of fuel in North, as well as increase our domestic open market coal as well in our East plant. And last but not the least, our focus has been to kind of reduce the petcoke consumption from high of 48% all the way come down to 41% now, which is an impressive number. With this kind of petcoke reduction, we would be able to offset the rise in petcoke prices, if any. And also, our teams have been very innovative in trying to use power plant reject coal and as well as coal washery reject coal for our CPP plants, bringing down the power cost of CPP from close to about 0.95 rupees per million cal to as low as 0.8 rupees per million cal. So basically, reduce petcoke consumption. Second is get increased focus on AFR, and last one is to kind of work on CPP coal. With all these 3 initiatives, I think we should be able to defray the potential increase in petcoke prices at prevalent levels. In the unlikely event of a big time increase, I guess that's going to be a challenge for the entire industry. But as we see today, we have fuel stocks for a month or 2 right now, and with the fuel stocks which we have, we should be able to sail through Q4. And on the second point about capex plans, in the previous call, we had spoken about the overall capex outlay for the company. Obviously, we have the capex for the existing operations as well as capex for the Vadraj. So overall, this year, as of 9 months, we have spent close to about 320 crores of capex as of December, and the balance 3 months we should be spending close to about 200 odd crores. So for the full year, the capex outlook is coming anywhere between 620 to 670 crores.
Okay. And then if I can, squeeze in one last question. A lot of advantages that you mentioned of Nuvoco, especially on cost front, are, are in the east, in the eastern assets. But when we will start, Nuvoco will start Vadraj, a lot of these advantages will not be there. So in the initial years, can you give a sense of how much the cost might increase, as capacity ramps up at Vadraj?
Well, if talking about what happens, okay.
Yes,
So Vadraj starts, anyway, Vadraj is going to be run on petcoke fuel for kiln similar to our Nimbol and Chittor. So the ballpark number will be same as what Chittor and numbers are terms of fuel cost per kiln. The other advantage is Vadraj is that area we have lignite. So the captive power plant is going to be based on lignite as a fuel. So when we have done the initial calculation, our energy cost for Vadraj plant, other than the startup challenge of starting a new plant, other than that, I guess in terms of somewhat steady state, our fuel cost, energy cost, it will also have a CPP similar to what we have in Chittor and Nimbol. So it's kind of a copy of our operations. So the cost lines of Vadraj in terms of power and fuel will be more or less same as what we get in Nimbol and Chittor as we start the plant.
Understood. Thank you so much. I'll join back with you.
Thank you. We'll take our next question from the line of Amit Murarka from Axis Capital. Please go ahead.
Hi, good evening. Thanks for the opportunity. So just a question on leverage. So in the presentation, I think you've shown debt at 4217 crore and plus 600 crores as short-term bridge loan and CCDs. So just wanted to understand a bit more about the CCDs as to what are the conversion terms and by when does it come up for conversion?
It's during the last call and the one before, we have already said that when Nuvoco reaches 3,500 to 4,000 crores, that's when we kind of start our next expansion, that's how we started the entire Vadraj process. And the entire fundraising bit for Vadraj was we had to pay 1,800 crores as an acquisition cost for Vadraj. So to get that 1,800 crores funding, so we had started with 600 crores of long-term debt and another 1,200 crores of bridge financing till the CCD route was decided by the organization. So first I'll explain the 600 crores. The 600 crores sits in this 4217 as mentioned in our investor presentation. The 4217 crores debt level at December 25 has built-in number of 600 crores. So if you have to do a like-to-like comparison of our past periods, this number is 3617 and with compared to December last year it was 4350 and that's the kind of debt reduction deleveraging company has been able to do in the last few years. So 3617 add 600, 4217 and that 600 will sit in our books as a long-term debt for Vadraj acquisition. We mentioned that the 1,200 crores will be in the form of a CCD. I will ask Manish to explain how we have gone about doing the 1,200 crores in two 600 crore tranches.
So, in terms of the specific terms of the CCD, which is the tranche that has been done in the month of November as the query. So basically, there is a call option and a put option as a part of the CCD. So Nuvoco will have the call option and will have the right, though it's not an obligation, to buy out the investor, depending upon our balance sheet position at that point in time and the market conditions. So basically, this call option is exercisable at the end of the fifth year, at the end of 5.5 year, and at the end of the sixth year. So these CCDs are for a period of 7 years, and so as I said, the call option is after a fifth, 5.5, 6 years. So these 600 crores CCDs, Series A, this is into 3 tranches of 200 crores each. That I've talked about, and it is mandatory, it gets converted into equity at the end of 7th year. And it carries a coupon rate of 0.1% in the books.
Yeah, the 600 crores, just to pick up from Manish, so it gets consummated at 5 years plus. So at the time, Nuvoco's balance sheet will be much stronger than where we are currently. So we have the call option at the time, and it's as Manish says, thing of 200. The second 600 crores, we have still not completed the short-term debt into CCD. I guess due to year-end holidays in the market, so we are still under discussion, should be concluded in the coming days.
Okay. So what I understood is that it is compulsory convertible into equity at the end of the 7th year.
That's right.
And what would be the price at which it gets converted?
So I think you can take these things offline or separately from the investor relations department. So as I said, it is a call option at the end of 5 years, 6 years from Nuvoco's perspective. So the intent would be depending on the market conditions.
I think at that time we should have a pretty strong balance sheet to kind of use the call option and repay the CCD. That's the idea which we have. In the most unlikely event, that's when I guess the put option will be exercised on the promoter group company.
Understood. So you are basically the idea is to essentially repay off this in the 5th year itself, and through the cash flows that you will generate in this period, and not really wait for the conversion into equity.
No, absolutely. That's the intention. I guess as we speak, we would be 3 years from now at a CAGR of 7%. Obviously, the business will grow to a much higher volume, and also with the volumes coming from Vadraj, and with the overall market opportunity, we should be able to generate much more cash, and the balance sheet should be much stronger. And as I mentioned, the kind of business projections which we have in place, we should also be able to fund the Vadraj capex through internal accruals, and then we should be able to retire this CCD. But I just want to mention one other point to you is, many times I've mentioned in our calls, almost all times I mentioned this particular point in the call, stating that as a company, we are comfortable operating the company with the debt levels of 3,500 to 4,000 crores. That would continue to be, we are not going to be going into the path of retiring all the debt. I'm sure if really business scales up to that level, this debt level also should come down, but we have the ambition of growing the company beyond Vadraj as well. So I guess we are comfortable with the debt level of about 3,500, and at that time with EBITDA levels coming, we should meet our covenant. So we targeting EBITDA to debt level around 2-ish at the time as well. So comfortable position to retire the CCD on a call option and still grow the company.
Sure. Just on the last question on the CCD bid. So at the 5th year, when you have the call option to buy the debt out, will it be bought out at 600 crores, or will there be something additional that is required to be paid?
It has to be additional because that's how the whole structuring is done, because all the so-called interest adjustment will happen into the principal of 600, which is in the form of CCD, and then the payout will be happening on top of all the yearly compounded number when it comes to 5th year.
So what is the implied interest? I just want to understand, while I understand that this is a structured transaction debt.
No, it's so, Kamal, what we'll do is to share this, so this should get into a long discussion. So may I request you to reach out to us, come over to our office, or let's set up a call. We'll explain all of it in complete detail, because obviously all of it is in the public domain. So we should be able to give you all details. So anything that is needed, reach out to us. We should give you every bit of detail.
Okay, sure. Thank you so much.
Thank you. We'll take our next question from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. Just a follow-up to the CCD question. The remaining 600 crores you are still waiting to tie up. Is that, have you locked in, basically the investors are more or less identified? Is it the same set of investors? Is it just some procedural delay? Just want to understand where are you in the process. It's been a while since that Vadraj deal happened. Obviously, you've closed 600 crores. The remaining 600, was trying to find out similar investors, different. The structuring is also going to be similar as we look at that 600 crore.
Yeah. So the structuring is more or less going to be the same. Maybe the numbers could be slightly different because it's not going to be exactly the same set of people who will do. We are more or less at the final stage of discussion. So it is nothing to do with any challenge or anything which we have faced. Just that year-end happened and then the market, so the people with whom we are working have just come back. So it should happen. I can't give you a timeline whether it will happen in a week or 10 days or 2 weeks. But suffice to say that we are on top of it and this should happen pretty much in the near future.
Okay. And on this Vadraj asset, just maybe an update on the rail line. I know it had already reached Nalia. What is the status for last mile connectivity from Nalia to your plant? And then from there also, have you seen other players start basically transporting from that particular stretch, or is it still in future?
That's kind of more or less stitched up. The railway survey is already completed within Nalia and into a place called Vagod. Vagod is a station which is about 4.5 kilometers from our plant. So the survey, railways have started working on that, and I think the land acquisition that is going to be done by railways. I think their initial project report says that they should be ready completing this up to this Vagod station by end of this year, December, January. They should be able to complete. In parallel, the whole distance for us is there are obviously other than that there are two other plants. I think they're also kind of pursuing from the same Vagod chalk, and then that's when the line branches out to us as well as to the other two players. For us, from that station to our plant, outside our plant boundaries, about 4.5 plant boundaries are our land. So we already started completed the land survey, the railway route finalization, the DPR and ESP is all done. Only on last week, Wednesday, I've kind of approved the purchase order for the party to work on the railway siding as well. So it all happened parallelly. So our plan is to start work from inside the plant. Already we have control over the land, so the work will start from inside our plant compound all the way to the place where the siding comes inside our plant. And in parallel, I guess, land acquisition, a lot of patches of land is government land, so we're already working with government of Gujarat. So by the time work starts, we should have completed the acquisition of the land, and when railways is ready by end of this year, we won't be able to complete the project by end of this year. It should take longer than that. Our target is June FY28 is when the siding is going to be completed. So we are on top of it, on course to complete stuff. The other two guys, I guess, they should also be working on the same lines.
So as of now, the other two guys, their plants are operational. Have they just want to understand because the line is there till Nadia. So have other players started shipping? And when you look at the last mile connectivity, and assuming some delays, you're mentioning June 28, but for at least the monsoon period, it's a fair weather port. Should we assume lower utilization for the first year till this last mile connectivity is there? Just maybe an update on are other people using that line as
the Nalia siding is already being used by other companies. So I guess the Nalia siding is anyway operational, though it doesn't have any handling facility. Obviously, it's a manual handling, loading into N box and moving the material. So that one is operational. So push comes to shove, we will start with Nalia. Not a problem at all. And by the time June of next year, monsoon will hit July or something, I guess we should be ready by then. In the unlikely event, Nalia is always there. It's a little bit additional cost to move material. Other than that, the jetty route is already there with us. Jetty route will also be there. Then the Nalia route will always be there. But I think beyond June FY28, we should have the railway siding operating out of the plant, and dispatches should happen within the plant. So as I see today, we are on top of things. Obviously, in a big project like this, there could always be small delays here and there. But I don't foresee any major stumbling block in this because I guess backup in Nalia is there. Jetty is, we have already done the bathymetric survey and then we know how to kind of ferry material out of the jetty, cut jetty as well. So the jetty route is also going to be operational around the time the clinker starts production. Nalia will be ready when the clinker production starts. Surat would be operational before that. So by the time siding comes by Q1 end, we should be fully in business moving material. As regards to your second question of whether it meets the scale up of the company. So as I mentioned before, our overall scale up is 1, 2, 3, 4. That's the kind of number which we had in mind. 1 million in FY26, which is we will exit the year at a million kind of annualized million sale in Gujarat. Next year we should be going into, by end of the year we should get into 2 million sale, and FY28 will be 3 million and FY29 will be 4 million. So that's the broad plan which we have. We are to achieving and delivering those 1, 2, 3, 4 agenda.
Lastly, on Gujarat specifically, because you're expanding there in a big way. I know you're catering to that market right now with the 1 million ton that you mentioned through North, but would you have to, as you look at bringing more volumes, when should we look at maybe upscaling your branding team before that capacity comes online? Is there something you need to do to strengthen your position of branding or team there in that region, and when would you start to do?
I guess it's all about timing because I start spending money right now, I will be wasting money. If I spend late, I'll be losing the opportunity. So we have a clear blueprint in place when to kind of get into investment mode in terms of market investment and media investment. But what are the things which you've already done? We have a full-fledged sales force in place. We have the sales officers in place. We have the market study done, and then dealer appointments are started happening. So by the time even the month of December, we already sold in the state of Gujarat 1.2 lakhs, and our target in Q4 is going to be similar kind of numbers every month. So we've kind of scaled up to this kind of 1.2 would already mean more than 1 million ton of sale will happen in the first year itself. So that sale cannot happen unless until you appoint dealer network, which is already there. But as regards advertisement, marketing, and other spend, so I guess we have a blueprint in place. But in this call, I won't be able to tell when I'm going to break. But certainly on top of things, and by the time our Surat training unit is operational, we should be having all this in place in the market.
Okay, thank you so much and wish you all the best.
Thanks.
Thank you. Next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Hello.
Hello, Rajesh.
Am I audible? Yeah, hi sir. Good afternoon. Good evening. Question pertains to the fuel and power cost. This 1.41 when you say per million cal, this is inclusive of your thermal CPP power cost, or this is only kiln fuel cost?
This is kiln fuel cost.
This is kiln fuel cost, okay. And what would be in the kiln fuel, what would be the linkage and petcoke and other coal mix?
Petcoke on the kiln, as you mentioned, is Q3 FY26, we have delivered 41% petcoke is the petcoke usage in our kiln. This has got a higher load in north and a lower load in east. This is a blended load for the company as whole at 41%. We were at a similar time last year, Q3 FY25, we were at 48% petcoke. We are at 41% petcoke. Linkage coal is 34%. Non-linkage domestic coal is 15%.
Okay. And AFR would be the remaining?
AFR, 10% is Q3 FY26. Here we should improve because last 1.5 months we had two main plants, Rizda and Nimbol, under shutdown. So both these plants have the AFR facility, so the number is slightly low. Our target before shutdown of these plants, Nimbol was already at 15% and Chittor was already at 15%. So I guess some ramp-up time will take in the next 3 months. By Q1 FY27, we should be able to get this number to anywhere between 13 to 15% at a company level.
Understood. And sir, lead logistics cost this quarter has come down. So there is any reduction in lead distance, or what specifically has led to correction in your logistics cost?
Our lead distance in Q2 was 331. We are at 326 kilometers this quarter. There's a good reduction of 5 kilometers. Most of the reduction has come in the secondary side, and in fact is due to the secondary side reduction, where the PTPK is more than the primary PTPK, and that's one reason why our logistics cost has become efficient in Q3 FY26.
So because if I look at from Q1, Q2 level, it is down almost by 70-80 rupees per ton. If I look at the average of H1, it was 1525. Now it is 100 rupees lower in Q3. So what explains this?
Three things. One is lead distance, which I mentioned. The second one is all our primary freight has got GPS fitted now. So we are running a very tight system to ensure that any potential leakages in primary is reduced to a big extent. And third, most important thing, we have mentioned in the a year ago, 2 years ago, we started the Sonadi and Jajpur railway siding. And for the Jajpur plant by road, that's totally eliminated now. All clinker movement in east is happening only by rake. So that's a big savings in terms of clinker distribution cost has come down, which is, we have all one time we had mentioned in the previous call that the clinker movement cost should come down anywhere between 25 to 35 rupees kind of a number. That added to lead distance reduction, GPS implementation, and last but not the least, increased focus in Chhattisgarh sales and Rajasthan sales has also reduced the overall lead distance, which is composite, multiple reasons to explain the reduction in distribution cost.
So how much is your rail share now, which was 40% in Q2?
I can give rail share for the country as a whole. Just give me a second.
Yeah, total on a total basis.
I'll give. Our rail share is 37% and road share is 63%, 9 months FY26. And at Q3 also 63-37.
Okay, understood. Okay, and so lastly on the power cost, your green power mix is holding up around close to 20%. Okay, what are the opportunity there to increase this? Because most of your peers, they're all inching up to 40-50%. So can you give me a breakup of your power, power usage grade, CPP and, renewable power, and what is the thought there?
Currently our CPP is 150 megawatt and WHR is close to about 45 megawatt. Put together we are at 195, 196 megawatt. Our plan is to debottleneck all these WHRs to get another 3.5 megawatts in the next 6-8 months. That's the number one way to increase the green power. We also have very small solar power in Chittor factory, and which is a very small one. Along with that, we have a 1 megawatt solar power in Bhiwani and a 1 megawatt solar power in Jajpur factory. So these two are the current initiatives. But in the last 1 month, we have signed an LOI with the company to set up a hybrid power plant in Rajasthan, and that should be operational in the next 12 to 18 months. Which should give us a big boost to power cost in Nimbol plant, and that's a 50 megawatt hybrid model which we are working, which should be one of the large investments which we are making going forward. It will not be a capex model; it's going to be a group captive model which we have concluded very recently, and that work should start very soon.
So 50 megawatt will be the installed capacity, and it is solar, right?
It is a hybrid, solar plus wind.
Okay. Now, I just want to, why my question is, most people are doing this RE power through JV mode to reduce their landed power costs. So, what sort of power cost reduction? And given that many companies, if you see your few competitors have recently invested 45 crores with a payback period of what we understand, these JV projects have a payback period of less than 2 years. So is it not an opportunity for you to invest into, invest say 100 odd crores through JV models and increase your green mix from 20 to 40% plus and, in turn also reduce your blended power cost by, say, 1 rupee or?
Very much. I think Rajesh is very clear. If you look at where all we operate in Rajasthan, that's a big cluster for us. Chhattisgarh is the second biggest power consuming place, and the third one is West Bengal, where we have 2 GUs. So our highest power cost for the company comes from Rajasthan, both because of petcoke cost as well as the overall power cost in that place is high. And the rules of Rajasthan got changed only recently. As soon as the group captive and the banking model came into economically right frame, we have gone ahead with this group captive model of putting up a plant exclusively for Nimbol. What we do in the second plant is based on our experience of Nimbol. That's the first thing. When it comes to Chhattisgarh, the first thing which is important for us is we run on a what you call linkage coal is a big component in Chhattisgarh. And the second one also is all the 3 plants grid integration in Rizda, Arasmeta. So what we run is all these 3 plants run on a grid, and we many times we shut the CPP to use the grid, or we shut the grid and use power from one factory to other factory. It's a common grid, and we have got a solid benefit out of it. The payback was close to only 7-8 months, and more or less the job is done. We will go for a captive plant in Chhattisgarh once the economics of captive plant outweighs the savings which you are making out of our current model. So it's very much in our agenda. It is economics which will drive at this point of time. Lastly, it is Bengal. Bengal, still the group captive model is not working because the rules of space does not facilitate what we have in Rajasthan. We don't have proper banking arrangement there. So once that happens, that's the place where we'll go for.
Understood. What is your blended power cost currently? 9 months and QC?
Blended power cost for the company is very good. Just a second, please. The blended power cost for the company is close to about 335 rupees per ton.
325.
335.
Okay, understood, sir. That's helpful. Thank you, sir. All the best.
Thank you so much.
Ladies and gentlemen, in order to ensure management is able to answer queries from all participants, kindly restrict your questions to 2 at a time. We'll take our next question from the line of Prateek Kumar from Jefferies. Please go ahead.
Yeah, good evening. Congrats for great results. I have a couple of questions. Firstly, on your premiumization mix and increasing rate over last few years, how do you think your gap has closed or increased versus other best brands in the market? And how does increasing premium mix contributes to your EBITDA per ton?
We've got some bragging rights on this. So certainly from FY22 till FY26, 9 months, our premiumization percentage as a percentage of trade volumes have moved from 34 to 36 to 37 to 40 to 43. And Q3 we had 44% of premiumization. We have Concreto, which is the flagship premium brand. We also successfully launched Concreto Uno in Bihar, Bengal and Jharkhand. And the Duraguard microfiber is sold in Chhattisgarh, Orissa, Rajasthan, Western MP, Haryana, other north markets, and also in Gujarat. So that's something which, and if you really look at rest of the other companies, I'm not going to rattle out other companies. I think they are at a different level. We are at a different level. Certainly, going forward, this will be a source of strength for us. We will further strengthen in FY27 and beyond. Certainly to increase this number. We are really looking at increasing this number certainly at 200 basis points every year in the next 2 to 3 years.
Sorry, my question was regarding how your net realizations or market pricing would have increased or gap on a better side versus your competition during this period, and contribution of better premiumization on a EBITDA per ton.
Yeah, at the premiumization level, we can't look at an all India level because premiumization has to be calculated of the base product in the state and the premium in the state. Contribution changes from state to state. Suffice to say that at a premiumization level, we can get anywhere between 150 to 200 rupees increased contribution per ton of cement sold. So that's a big boost. And as we go forward, this will provide us leverage to overall improve the realization for the company.
Okay, and my other question is on your 4Q. So we have seen acceleration in demand growth for your company. Based on current trends, because we had a very high performance base in Q4 last year, we look volume growth accelerating from 7% this quarter. And also a related question on pricing, how is your pricing undertaken on 10-12 January compares to the exit price of December quarter?
Yeah, I guess first one is in terms of Q4. Obviously, our base was high last year. We sold 5.7 million tons in Q4. So I'm really looking at good growth. If you remember my previous call in Q3, I mentioned that demand for the industry should be anywhere between 7 to 8% kind of a number. So we hope to kind of hit that number or cross that number certainly going forward. That's on the demand side, basis side. But I guess Q4 overall the cement industry also peaks, and then we will certainly ride the demand perking up. Second, in terms of the price increase and the impact of price increase, as I said, as an answer to the first question, pricing corrections we took around 10th, 11th of January. So non-trade prices have moved in most markets. Trade prices also have moved in certain markets. I'll have to wait for the next week or 10 days to see whether these prices continue to remain where it is there. I see no reason why prices coming down from where we have taken them, because these prices have to sustain going forward, and also in a quarter where demand is going to be pretty robust.
Thank you, sir, and all the best.
Thank you. We'll take our next question from the line of Tejas Pradhan from Citi. Please go ahead.
Yeah, hi, sir. So you had mentioned that you will be expecting 7 to 8% demand growth in fourth quarter. Now, from fourth quarter last year, if I'm not wrong, we operated at 90% plus capacity utilization, and I assume there'll be a regional skew over there. So, how are we placed in terms of having capacity available both from grinding and clinker capacity perspective to sort of meet this demand growth that could be there?
Yeah, we have to divide our market between east and north/west. Certainly in the north markets sourced from Chittor, Nimbol, we would be operating at near capacity utilization in Q4. That's very clear. The only way we can get more volumes is to go more and more into blended cement, even in non-trade category, and that's our goal in Q4 to kind of get our 6 million tons of capacity in north. We will set our assets to come very close to that number. However, in east, we still have a lot of headroom. Our installed capacity in east is close to clinker capacity, not installed capacity. Clinker capacity is close to about 20 million tons at CK ratio of 2.1. So one of the goals here again is taper down the OPC levels in non-trade and go hammer and tongs on trade levels. We have sufficient headroom in east to kind of get the growth this year, even next year at double-digit growth, and year after also a double-digit growth. So certainly suffice to say for the next 2.5 years, we have adequate capacity in east to kind of sweat the assets and get the volume growth going. The other one which we will certainly work on is get into more and more blended cement, get into more and more slag cement. Also, Concreto Uno is a composite cement. It's a premium composite, so we'll more and more switch over from plain PPC or plain PSC into composite to do clinker release. So clinker release will be an agenda. Moving from OPC to blended cement, whatever little we do will be the second agenda. Sufficient headroom to grow. Certainly in Q4 and beyond FY27 and 28 also we have adequate capacity in the east. North will be a tight scenario. after this quarter, we'll continue to operate at near capacity utilization in North, and that's one of the reasons Vadraj will come into play. Once Vadraj capacity comes into play, we release close to about the current 1 million ton sale in Gujarat into North markets, and certainly get Vadraj to serve Gujarat as well as West Maharashtra, or also some bordering portion of West MP also will happen from Surat factory. So all in all, the entire Vadraj expansion strategy is to release capacity in North, and East we are self-contained for the next 2 to 3 years.
Okay, sir. Just to add on to that, so if I look at the presentation, the cement to clinker ratio for 9 months is mentioned at 1.72x at the company level. Could you break this down into East and North? What would be the CK ratio in those regions separately?
East will be close to about 1.95 to 2. North will be about 1.3 to 1.35. So we'll have to further improve North move away from OPC to PPC. I guess that's going to be the focus in the coming 2 quarters to release cement, and because there's growth in the market, we'll have to move away from non-trade into trade and move away from OPC to PPC. We hardly sell any OPC in trade, so whatever little non-trade OPC will move from based on contribution, of course, into PPC. East certainly at 2. We still have headroom to go to 2.1. In certain markets, we have done 2.1 in the past as well. We should go to 2.1 very soon. So there again, I think we will curtail the OPC sales in non-trade and go out and out into PPC, or move from PSC into composite cement.
Okay. And in the interim, do we have any scope for any debottlenecking, or we have already sort of exhausted the likely limit?
As we speak right now, we don't have any debottlenecking plan in East. However, the cement capacity increase of 4 million tons grinding will help us more grinding capacity closer to the market to get this capacity going in the market, and also the Chhattisgarh GST benefit will help us garner a little bit more money by the debottlenecking in Arasmeta. The entire composite cement agenda, blended cement agenda for the company is the reason for doing the expansion of grinding units in East. Not the
clinker perspective. I was checking from
I'm talking about that. Yeah.
Okay. Sorry.
Right. Hold on for a second. I'm coming to that.
Yeah.
East, we have debottlenecked. Our installed clinker capacity is close to 9.5 million tons. So we can always get the squeezing done to 0.5. At this point of time, I'm not focused too much on increasing clinker capacity from 9.5 beyond, simply because I have headroom. Even with 9.5 at 2.1 CK ratio, I can go more than 20 million tons in East. And I have adequate cement at 2 million, 10% growth for next 3 years. I have adequate cement capacity unlocked for East. Maybe same time next year we can think about debottlenecking. We don't have plans to put a full-fledged clinker line in East at this point of time, but maybe I think as the year progresses and we come into next year, we can look at that. In North, debottlenecking certainly we will do. We already debottlenecked Nimbol from 4500 to 6100. That's a big debottlenecking exercise we did. Chittor factory used to be 5,000, we went to 6,100. But right now I don't have any plans to increase the clinker capacity North from 6,250, 6,250 is 12,500. Vadraj will be the one which will come and help my clinker capacity in North.
Sure, thanks. And just one last question from my side. What would be the cost of borrowing for the company as of now?
Just a second.
So it is currently in the range of around 8%.
8%. Okay. Thanks a lot. That's it from my side.
Thank you. Participants are requested to restrict their questions to 2 at a time, please. Next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi. Thank you, sir. Sir, just to summarize, so at a blended level, given the 3 million ton the capacity that will come up, particularly this East one, so 1 million ton, I hope will be coming by March, Jojobera and Jajpur. Jojobera and Panagra will be coming by this March, and maybe 1 million ton Jajpur by 1Q FY27, and plus 2 million ton Surat also will be coming up and will be available for the second half of FY27. So at a broader level, this fourth quarter, at least we should be doing 7-8% growth, and for next 2 to 3 years, as you are highlighting, at a blended level, closer to a double-digit growth is doable.
Absolutely. I guess you summarized everything what I wanted to tell. Certainly in Q4 our target should be what you mentioned, and next year and beyond we are targeting a CAGR of 10% volume growth at least for the next 2 years, if not more. Surat will give us, Gujarat will give us the benefit in East, in North, and East with the Jojobera debottlenecking, more or less it is going to be ready. I guess in the next 2 months we should have Jojobera expansion completed. Jajpur expansion, Panagar expansion work has started. There is something called NIU approval, so we are working with the governments for getting the no load increase approval, which is happening currently, and side by side the modifications are happening in this steel plant. Arasmeta debottlenecking it will be a little bit longer because it involves putting up a totally new mill. That should be available in FY28. FY27, certainly Jojobera expansion will be completed early part of FY27, and even Panagar and Jajpur, I guess we should be ready by max Q2, but certainly end of Q1.
Okay. Got it. Second, sir, to summarize in terms of the cost, including even the startup cost for the Vadraj. So from here on, in terms of at the company level, in terms of the cost saving, how one can look at?
This is our annual operating plan time. I guess when we meet in 4Q numbers, I'll be able to share the next 2 to 3 years cost saving agenda for the company. We are currently working. So next time when we meet, I will be able to share with you the next 2 to 3 years cost saving agenda for the company.
Okay. And sir, capex you have mentioned for the fourth quarter for FY27 and 28, if you can, because I think the Vadraj capex was slightly getting postponed to FY27. So for FY27, 28, if you can spell the capex number.
FY27, I'm looking at the overall capex of close to about 1,000 crores. And FY28 close to 700 crores. 26 will be 650 crores is what I mentioned. 620 to 670. Let's take 650 as FY26. FY27 should be anywhere between 1,000 to 1,050 crores. And FY27 will be anywhere between 650 to 700 crores. This will have Vadraj capex, which will come. We already spent close to about 200 crores in Vadraj by December. We should have another 300 crores, 250 crores, which will happen in the next 2 to 3 months. Then on next year, about 800, and the year next, another 500 for Vadraj. Rest will be routine capex. So overall, summing up, FY26, our capex will be 620 to 670 crores, give or take 50 crores here and there. FY27 will be 1,000 to 1,100 crores. FY28 will be 650 to 700 crores.
Sorry to interrupt. I request you to join back the queue, please.
I'm just completing that. So does that mean So does that mean that we are not factoring any kind of a capex for Chittorgarh expansion? So that should be happening in the FY28 at least. So
at this point of time, it's too early for me to say when we will start. Either we'll start in FY28 or FY29. It could be give or take 1 year here and there. But I think let's get into FY27, H2 of FY27. We will give you clarity on when do we start, because we've got still, like Vishnu mentioned in his opening remarks, we have options with Gulbarga, we have options with Chittorgarh. We have the Nimbahera mine. We also have the JMK mine in Jodhpur, and also have the Gulbarga mine. So we will decide closer to the date where we will expand, either a greenfield expansion or a brownfield expansion. FY28 onwards it will start. But it's too early for me to say when I'm going to put money. It could be H2 of FY28 or Q1 of FY29.
Okay. Got it, sir. Thank you.
Thank you. We'll take our next question from the line of Naveen Sahdev from ICICI Securities. Please go ahead.
Yeah, good evening and thank you for the opportunity. Hello, am I audible?
Yeah.
Yes, please go ahead.
Oh, great. Yeah, great. Thank you. So, two questions. One was on the industry-wide pricing. So, as you said, you've taken some price hikes in January. Now, and you also mentioned that December as a month, not just, it witnessed a double-digit kind of a growth. And I think our channel checks are also indicating both North and East witnessed a very decent, or may I say very bumper sort of a rebound volumes in the month of December. Typically, January volumes are at par to what they are in December. So my question was that if December as a month which witnessed such a sharp recovery could not give any prices, rather prices continued to reel under pressure, what gives the confidence that January would see some better pricing, please?
Volume certainly from the first 14 days of the month, I guess we are tracking decent volumes. I'm sure industry also is demand for cement in general is pretty good in the market as January has started. So I'm not going to put any adjective to the past month, but certainly I think December was a good month for us and maybe for industry once their results are published. But certainly in January, I see a demand sustaining from December 20 levels, December 20th to 30th levels, and that's the reason why we have gone ahead and made this changes in pricing. So as I said earlier, this is just only 1 week into price increase time. So I will wait and watch going forward whether we are able to sustain these prices. So my gut sense is the prices had fallen below to GST levels because we had passed on all the benefits of GST and we continued with the quarter. But with a little bit of a cost inflation, we had to do some adjustment, and that's how we took this correction. Non-trade prices had gone quite below trade prices, and that's the reason why we took the correction in non-trade first.
Understood. Helpful. Second is a slightly long-term or a mid-term question. This is with respect to the capex plans that you have mentioned. So historically, you always mentioned that whenever the net debt of the company comes to, in the range of 3,500 to 4,000, you will pursue the next capex, which you are doing in the form of Vadraj. So now, since the last 2 quarters, you've been mentioning medium-term growth plans of Chittorgarh plant and a greenfield optionality for Gulbarga. So is there any thought process as to at what levels of debt will the company then again, net debt or the net debt to EBITDA, will the company look to pursue these capex?
I still continue to say that we will pursue our growth at this kind of numbers in future as well. But with this kind of capex spend in the last year with Vadraj acquisition and going forward in the next 2 years, certainly we need to have the next set of expansion moment we complete Vadraj. So, but the current focus is going to be getting Vadraj right. So we are a company which goes 100-time company, so that's how we will progress on this. When we reach FY28, I guess as I answered the previous question, sometime in FY28, either H2 or Q1 FY29 is when we will start the next phase of expansion. But as I build the business plan for the company from current year to the next 2 to 3 years, we should be in a pretty favorable position at similar kind of debt levels 2 years from now for us to kickstart the next expansion.
Noted. One question, if I can squeeze in. Sorry. So very quickly, your freight cost tends to be very volatile. I mean, it's heartening to see a decline, but then it also tends to bounce back. For example, in Q4 of 25, it had fallen on a per ton basis as low as 1,401, but suddenly in Q1 we saw a jump to 1,550. So I'm just trying to understand. It's good to see the current quarter's outstanding, reduction in the freight. But how sustainable is this? Is my only limited question. Thank you.
To keep the freight cost under control, I think there are 2-3 levers which we have done. Certainly, I think the railway siding in Sonadi and Jajpur has been instrumental in reducing the clinker movement rate, which is important. The second one is with the starting of our Bhiwani factory. The lead distance of Haryana cement planters got positively impacted. As regards to your question about erratic behavior of our freight cost, so I would say that certainly from FY25 Q2 onwards till as we speak, I think gradually we are chipping away the freight cost, mainly due to 3 reasons. One is focusing on home markets and reducing the lead distance. Second one is the railway siding in Sonadi as well as Jajpur. But one of the principal reasons is we are a company which is on 37% rail share and 63% road share. As you would have seen, post-COVID for the next 2 years, the government did not levy the freight subsidy for lean season. They delivered freight subsidy for lean season and suddenly they went back again 2 years, year and a half, last year I guess. This FY26 and FY25, the freight subsidy got cancelled. Hence the freight cost increased because we have a certain big amount of rail share and the overall freight cost increased due to subsidy going away. From now on, from last year, which is FY25 to FY26, I guess it's a steady state period. You will see us progressing continuously on sustained reduction in freight cost, mainly through home market sales, increased home market sale, reducing leakages through GPS, getting the clinker distribution cost between Jajpur and Sonadi. And last but not the least, one of the things which also came as a fluctuation in for 2 quarters was also in certain markets we moved from X to FOR, but then I think the entire industry works on a particular practice and then we had to change the model, and that's the reason where you would have seen some spikes on the freight cost. All that is behind us now. We now have a steady state market with sustained railway, with all the costs which are built going forward contains the lean season discount not happening during the period. Number 2 being Sonadi Jajpur siding is completed. Number 3 being increased focus on home markets in Rajasthan, Chhattisgarh, where the distribution cost should come, Haryana, distribution cost should come down. So suffice to say, as we go forward, we should be able to have efficiency improvement in logistics costs to get the maximum savings in the coming quarters.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to Mr. Vishnu Sharma for closing comments. Over to you, sir.
Thank you for all your thoughtful and insightful questions. We hope your questions have been addressed. The investor relations team is ready to provide any additional clarifications you might need post the call. Before we wrap up today's call, let me affirm our resolute commitment to driving sustained growth and strengthening our market positions. Vadodara Cement Plant project execution remains on track with phased commissioning targeted from Q3 FY27 to strengthen our western region presence. Our eastern expansion, fueled by strong demand for blended cement under Concreto and Duraguard, will further enhance our leadership position in the region. Looking ahead, we will continue to drive premiumization, an area where we have consistently expanded our base and set new benchmarks, while maintaining our focus on geographical optimization and cost discipline to enhance profitability and create sustained shareholder value. Thank you for being with us today. Thank you.
Thank you. On behalf of Nuvoco Vistas Corporation Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.